recorded. Great. Thank you, Zoom. And again, a welcome to all of our viewers for this free webinar titled Budget 2022 Investor Musings. I will be your host for today, Sarodh Ramkhelawan, Chief Investment Officer at Bourse Securities Limited. And today we're really going to have a more informal conversation as to what are the implications for investors, what are the opportunities for investors arising out of the fiscal 2022 budget, which would have been read just about a week ago by the Honorable Minister of Finance. Now, there would have been some very clear initiatives that are very investor specific that would have been announced or proposed. And then there are also some broader macro level or macroeconomic level initiatives or measures that will propose that could affect your current investment holdings or your prospective investment holdings. So today, first of all, let's do a little bit of webinar housekeeping, of course. You may submit your questions at any time throughout the presentation using our question and answer box. We would encourage you to please complete the investor sentiment survey. It's very, very simple. It's just to gauge how investors generally are feeling. And it's 4 simple multiple choice questions. The presentation time today is expected to be just around 20 to 25 minutes. And we will be having the question and answer session at the end, either through addressing some of the questions submitted via the question and answer box, or once you're brave enough and comfortable enough, and we certainly encourage it, you can, of course, engage us verbally on this particular chat, bearing in mind that we are all certainly going to be respectful of each other's views and sentiments. So today, as mentioned, we're doing a quick recap of the budget, which we are titling tentatively as Very Tense Recovery. We're going to consider something that's increasingly at the forefront of investors' minds, and certainly Bourse, from its own investors, have been receiving more and more questions. Is a Trinidad and Tobago debt default imminent? And certainly there have been some commentators that have suggested that that is in fact the case. So we're going to take a little fact-based look at whether or not this is indeed a cause for concern in the very near future. Then we will move on to the investor relevant measures, of course, either specific or broader focus measures. And we will recap the entire session with some key takeaways for investors and what they should keep at the back or perhaps at the front of their minds when making their next investment decision. So let's get straight into it. A tense recovery. Well, the numbers that were put forward for fiscal 2022 seem somewhat optimistic given the performance that would have been generated in fiscal 2021. And that's why we're asking, is this going to be a credible revenue recovery? Revenues for fiscal 2022 are expected to be just around $43.3 billion, which is a very significant increase from the $37.1 billion that is estimated to be generated in the now concluded fiscal 2021 period ended September 2021. Now, it's important to note that in terms of the revenue estimate, initially at this same time last year, that revenue estimate was just over $41 billion. So we did, as a country, fall well short of that revenue expectation. And the question, of course, on the minds of many sophisticated and everyday investors would be, is that revenue target of $43.3 billion for the upcoming fiscal year going to be met? Expenditures were very sticky and unsurprisingly so at around $50.8 billion in the last fiscal year. And for the upcoming fiscal year, expenditures are perhaps heading in the opposite direction as many would have anticipated, actually increasing to $52.4 billion. And that fiscal gap, which is the difference between what we're spending as a country and what we're earning, is expected to be $9.1 billion. So we're spending $9.1 billion more than we are actually going to generate or expected to generate. And in the now concluded fiscal year of 2021, that number was actually 13.7 billion, so quite a significant deficit. And we'll take a look at how this stacks up in terms of deficits in recent history for Trinidad and Tobago. For fiscal 2021, growth is expected to come in at -1%, so the economy would have been expected to shrink by just about 1%. And for fiscal 2022, growth is anticipated to be in the order of just around 5% positive. And we'll see how that stacks up to our recent historical performance in terms of economic growth over the past few years. Now, in terms of that revenue generation for the upcoming fiscal year, much of that is going to be in terms of tax and non-tax revenue, with very little coming by way of capital revenues, in other words, asset sales. So in terms of tax revenues, that is expected to increase from 29.7 to $32.5 billion. And non-tax revenues are expected to expand from 6.5 billion to just around $9.8 billion. Now, non-tax revenues really comprises factors such as royalties, rents, interest income, and profit from public institutions, among other items, but those are the major items. And certainly royalties are anticipated to play a big contributor to that jump in non-tax revenues from 6.5 to 9.8 billion. And that is really going to be hinged on a very robust recovery, not just in terms of energy prices, but also in terms of energy production. The same case is to be made in terms of tax revenues, with taxes from corporations expected to rebound from that 29.7 to 32.5 billion, much of which would be increased energy tax takes or a tax take from the energy sector. Now, as mentioned, that is pretty much hinged on a very robust recovery in the energy sector. In fact, the Honorable Minister of Finance did project that crude oil production is anticipated to increase from its fiscal 2021 daily production average of around 65,000 barrels per day to just over 86,000 barrels per day, which is somewhat optimistic given that oil production has averaged just around that 60,000 barrel per day mark over the past 4 fiscal periods. But for fiscal 2022, the bringing online of the Ruby field, which is expected to generate between 10,000 and 15,000 barrels per day of oil by BHP, should contribute to some meaningful improvement in oil production for the coming fiscal year. The budgeted price of oil, of course, was mentioned as $65 per barrel, which is above the EIA estimate of $62.50 roughly per barrel for the upcoming year. But oil prices are currently hovering around just around that $80 per barrel mark right now. So as things stand in the current pricing environment, it certainly seems as though oil prices are in the right place for the country to benefit from a significant revenue upswing from crude oil production. With respect to natural gas, certainly the country is banking on higher production volumes. Fiscal 2021 was certainly a year to forget in terms of natural gas production volumes, with volumes falling from 3.3 billion standard cubic feet per day to 2.8 billion standard cubic feet per day, an over 20% decline. And it follows 2 consecutive years of declines in natural gas production. For fiscal 2022, the Honorable Minister of Finance did project an improvement in natural gas production volumes, increasing to 3.4 billion standard cubic feet per day. And we will certainly hope and remain very optimistic that those production targets can in fact be met. The budgeted price of natural gas is at $3.75 per MMBTU, which is above the EIA estimate, again, of $3.60 per MMBTU for that 2022 period. So certainly some fairly aggressive, if one were to be objective, some fairly aggressive estimates in terms of both production and pricing numbers, which would have fed into the revenue estimates for fiscal 2022. As mentioned, that growth number of 5% how does it stack up to the past couple of fiscal years? Well, it seems very optimistic given that growth for the past 5 fiscal years has been in negative territory, with fiscal 2020, of course, with the onset of the COVID-19 pandemic, registering at around 7.4% negative in terms of growth for that period. But again, that 5% number is certainly hinged on a very strong and robust energy sector recovery for the upcoming fiscal year. Turning to the expenditure side of the budget equation, we note that expenditures have been historically very, as we like to say, sticky, hovering around that $50 billion mark. And one of the trends that we have observed, or that onlookers would observe, is that that level of current expenditure, the current expenditure component of the budget, has been steadily increasing. So for the fiscal 2022 period, total expenditure is anticipated to be around $52.4 billion, with over 92% of that expenditure, or $49.8 billion, being recurrent expenditure, with only $2.6 billion being capital formation. And why this is important to investors and the country as a whole is because the level of capital formation and capital expenditure is expected or anticipated to generate some form of return for the country over time. So lower levels of capital expenditure and increasing levels of current expenditure means that we are spending or expensing more in areas that are quote unquote non-productive, and perhaps spending less on areas that could be potentially productive areas in terms of creating assets, valuable assets for the country over time. So that very sticky level of expenditure combined with some fairly, although a slightly more optimistic, but perhaps still below expenditure levels, will contribute to another fiscal deficit in the fiscal 2022 period of $9.1 billion, as we mentioned earlier. And this stacks up to some other quite significant fiscal deficits over the past couple of fiscal years. From fiscal 2017 to fiscal 2021, we would have seen deficits ranging from $8 billion as wide as $16.8 billion in fiscal 2020 and $13.7 billion in the most recently concluded period. Now, when our team looked at the numbers, on average, we have been generating a fiscal deficit, meaning we've been spending more than we've been earning, just about $9.5 billion over the past 5 fiscal years. And fiscal 2022, from October 1st, 2021 to September 2022, doesn't seem to be too much different in that regard, with that deficit going to come in at about $9.1 billion, or roughly 5.8% of our estimated GDP. And this graph really just gives a longer term look at the state of spending within the country. And we see that expenditures have been well in excess of revenues over the past several fiscal periods, with certainly very big deficits in fiscal 2017, as we would have mentioned, and fiscal 2020 with very significant shortfalls over time. So the big question on the mind of investors is a Trinidad and Tobago default imminent? And certainly by some more prominent regional Caribbean economists, that has been the case put forward. In fact, Trinidad and Tobago and the Bahamas have been 2 of the Caribbean countries named as the next to default, based on certain assumptions. So let's take a look at just really what is causing this increasing concern of default for the Trinidad and Tobago economy. And one of the things is that our debt to GDP ratio has been continuously increasing over the past several years, rising from just around that 60% level between 2016 and 2018 to a projected 87.2% at the end of the next fiscal period. And this projection was made by the Honorable Minister of Finance. And for the end of fiscal 2021, we are projected to have a debt to GDP ratio of 85%. Now, what this simply means in perhaps layman terms is that as a proportion of what the country is producing, the debt, our debt in relation to that proportion of productive activity is increasing and increasing at a rapid rate. And that is one of the causes for concern and perhaps some of the reasons why alarm bells are being rung by some that a default is imminent. Now, within regional comparables, the case of Jamaica, for example, the case of Barbados, at the point of default, their debt to GDP ratios were in the 140 to 160% type levels. And although our debt to GDP ratio has increased quite significantly in recent times, we are still well off those particular numbers. So our debt to GDP ratio in summary is manageable, but it is climbing nonetheless. One of the other factors that is in our favor, in the country's favor currently, is that our cost of funding is currently very cheap or relatively cheap, and there's ample liquidity or ample supply of borrowing capacity, particularly in the domestic economy. So when we take a look at the costs of what we could borrow at, and this is Trinidad and Tobago in US dollars on international markets currently, that number comes in at around 4%. And over the past 12 months, it would have ranged from as low as 3.4% to 4.4%, meaning that even if we do borrow on international markets, the cost of that borrowing is still relatively attractive and certainly quite manageable relative to our stores of international reserves, which we'll talk about later. On the domestic market, that range is much narrower. Over the past 12 months, the cost of borrowing money for 10 years by the government would have ranged between 4.7% and 4.9%. It's currently at the higher end of that range right now at around that 4.9% level. When we take a look at excess reserves in our banking system, which means the amount of liquidity that is quote unquote slushing about, we know that after peaking at around 14 billion earlier, a couple of months ago, that level has now normalized around that $7.5 to $8 billion level in the past few months, which suggests that there is still quite considerable liquidity that could be moved towards government bonds and invested in government bonds if the conditions remain as they are right now. For another signal in terms of borrowing stress or distress is the shorter end of the yield curve, and certainly within our domestic market, and that is borrowing in TT dollars. Over the past few years, there has been a flight to safety, as it were, in terms of government debt, and we can see that for government borrowings around that 2-year mark, based on the government of Trinidad and Tobago yield curve, the cost of borrowing have actually fallen at the shorter end of the yield curve from around 2.6% to 1%. So that suggests that investors in general are not overly concerned about the creditworthiness of the Trinidad and Tobago government, at least in the near term. And even as we go out to longer tenors, the 5-year, 10-year mark, we can see that those borrowing costs have been relatively stable, particularly at the 5-year level at around 3.6%. And again, at that 10-year level, hovering between 4.7 and 4.9% over the past 12 months or so. And then finally, when we take a look at our Heritage and Stabilization Fund savings, it remains broadly intact. Now, one of the worries for investors is that we have not actually been making contributions to the HSF. In fact, we've been withdrawing and making heavy withdrawals over the past several years. And the net contributions in that yellow color has peaked or would have peaked at around $4 billion in September of 2014 and is now currently at $1.5 billion, an estimate based on the latest figures that were presented by the Honorable Minister of Finance. But the overall value of the fund stays or has hovered at around that $4 billion mark, or sorry, $5.6 billion mark over the past few periods, certainly from the 2015 period, the September 2015 period coming forward. So despite net withdrawals, investment returns in that purple shade have helped to keep the value of the fund or the HSF up. Now that's a good thing on one hand. On the other hand, a couple of bad years of investment returns combined with continued withdrawals, as is more likely going to be the case in the next couple of fiscal years, could lead to some deterioration in the HSF. But for now, very positive market returns have helped to support the overall value of the HSF at around that $5.5 billion mark. So in that regard, our HSF savings for the rainy day fund is still in a fairly good position under current market conditions. So overall, Trinidad and Tobago has also retained its investment grade rating, if only just in maintaining that. When we take a look at the Standard & Poor's rating as well as the Moody's rating, our Moody's rating, credit rating, has actually fallen into speculative grade or non-investment grade, so below that or into this gray area here. And our Standard & Poor's rating has remained, despite the convulsions of COVID-19, within that credit investment grade credit rating status at BBB-. But of course, things could change if we continue to run as a country, continuing fiscal deficits, if our net international reserves are depleted very, very quickly, or if our Heritage and Stabilization Fund is also depleted very quickly. But as it stands for right now, we remain within that investment grade status. So overall, is default imminent? It is a lower probability at the moment, so certainly not imminent, but there are some structural changes that would help to ensure that default is really not ever in the mind of investors. And that would certainly be related to maintaining a fiscal balance, which in simple terms is increasing your revenues and decreasing your expenditures to the point that you don't have any shortfall in terms of what you earn relative to what you spend, which would help us to move as a country into a net debt repayment mode. Judicious use of external borrowing is also an important feature. We do have a relatively low external debt as a percentage of GDP ratio right now. And of course, a stabilization in our net official reserves, which currently stand at around the $7 billion mark, or about 8.6 months to 8.5 months of import cover. And that would have certainly been boosted by the recent injection of special drawing rights awarded by the IMF. But stabilizing that net official reserve and not having to inject foreign exchange on a monthly basis by the central bank over consistent periods, consistent monthly periods, would certainly help to assuage the concerns of investors with respect to default of the government of Trinidad and Tobago on its debt. So let's move now to our investor-specific measures that were announced in the budget. And there were a couple pretty interesting ones, pretty good opportunities that might be becoming available over the next fiscal year. Well, firstly, no pun intended, there is going to be an additional public offering of, well, it's no longer First actually, it's now FCGFH, First Citizens Group Financial Holdings, and the stock is currently suspended from trading on the stock exchange until October 18th, as that administrative process is completed. And the Honorable Minister of Finance did announce that just about 10.87 million shares of then First was going to be offered to the public at a date to be determined to raise approximately $550 million by way of capital revenues. Now that translates roughly to about $50.60 per share, which is coincidentally the closing price at which First is going to be converted to FCGFH. That's a mouthful. And that offering, or additional public offering, translates to just about 4.3% of the total shareholding of First, or FCGFH rather, shares. The company is currently valued at just around $12.7 billion TT. And after the proposed offering, once successful, the government of Trinidad and Tobago's ownership would be reduced to just around 60.1%, with the balance just under 40% now being held in public hands. So that's one particular opportunity that could come up. It is important to note that First has remained relatively solid from a capital adequacy basis. In terms of valuations, its valuations have increased to some extent. So it's a little bit more expensive than it was over the past 12 months on average. Over the past 12 months, in fact, its weighted average price was around $45 to $46. And in terms of trading volumes, this 10.87 million shares would be roughly 8.3 times the number or the total volume of shares traded in First over the past 12 months. So certainly a fairly significant amount of shares that are going to be offered to the public at a price that is probably at the higher end of its trading range over the past 12 months. So that's one measure that investors could look forward to over the coming months. One of the other measures that were mentioned was the initial public offering, or the intended initial public offering of shares in the soon-to-be merged entity between the Trinidad and Tobago Mortgage Finance Company Limited and the Home Mortgage Bank, referred to as the Trinidad and Tobago Mortgage Bank, or TTMB. Now, the Honorable Minister announced that it was their intention, or the government's intention, to sell all of their shares via IPO in this merged entity. Now, no specific details were given, but of course, Bourse would have done some of the basic math involved. The combined assets of the HMB and TTMF, based on their financial 2020 year-end accounts, would be in the order of about $7.5 billion. The combined equity would be just around $2.3 billion. And based on the existing shareholdings of both TTMF and HMB by the government and other shareholders, the government's holdings in the newly merged entity would be in the range of value of about $500 to $600 million. And that would equate to, based on our estimates, just around 25 to 26% of the shares of the newly merged entity. Again, details are fairly thin at this particular point in time. The pricing in terms of the shares would obviously have to be determined, and the timing of this would also be determined, and certainly dependent on the approval and completion of that merger between TTMF and HMB. To correct myself, the approval by both boards has already been given, so they are awaiting regulatory approval for the completion of this particular merger. SMEs, moving on quite nicely from that TTMB IPO, or proposed TTMB IPO, SMEs were given further enhancement to list on the Trinidad and Tobago Stock Exchange on that SME tier. And really, it was the pot was sweetened with a full tax holiday being granted, inclusive of business levy and green fund levy, not just corporation tax, for the first 5 years, and a 50% tax holiday for years 6 to 10, again, inclusive of the business levy and green fund levy, as well as an SME mentorship program to help those newly listed companies understand the listing requirements, get very familiar and very comfortable with them, and perhaps increase the scope of investment opportunities and certainly the investment menu in the Trinidad and Tobago market. Now, this has been an area of fairly lackluster activity over the past couple of years, despite the very generous incentives on offer. And we can see that since 2018, really only 2 companies would have listed on the SME tier, and that would have been Cinema One as well as Endeavor Holdings Limited. And when we take a look at the value of those shares that were listed, the market cap or the total value of the shares listed would be around $250 million currently, based on current prices. And when we take a look at the public or free float, meaning those shares which would have been offered to the public, the story is a little bit less compelling, with just about $12 million worth of shares actually available to the public at this particular point in time, and that value would have peaked at around 20 million back in 2019. So certainly, despite the very generous incentives on offer, the SME market does seem to be a little bit sluggish, and perhaps that may be more related to the particular disposition of investors and private company owners at this point in time in Trinidad and Tobago. And when we compare this type of activity, for example, to the junior market on the Jamaica Stock Exchange, it is, as we see, chalk and cheese. There's a very robust and thriving junior market or SME market in Jamaica, perhaps with a more risk-taking mentality by the average Jamaican investor relative to Trinidad and Tobago. But certainly there is much more active and successful listings on that SME/junior market tier in our Caribbean counterparts across the Caribbean Sea. So hopefully, as companies do endeavor to explore new avenues for growth, new businesses, and with a changing or evolving risk profile of the Trinidad and Tobago investor, we may get more traction in that SME space. Certainly the incentives are there for those SMEs that would want to consider listing. And finally, in terms of, or not finally, but in terms of retirement savings incentives, the government did, or the Honorable Minister of Finance did propose to increase the annual allowance or relief from $50,000 annually to $60,000 annually. And this is applicable to all approved pension funds, plans, and schemes, as well as deferred annuity or tax savings plans, like the individual retirement fund, which is sponsored and managed by Bourse. What does this mean for the investor? Well, it generates an increased annual tax shield from $12,500 per year to $15,000 per year. And that, of course, is on the assumption that your current taxable income rate is around 25%, and that you are maximizing your contributions, meaning you are contributing the full $60,000 annually to that particular plan. So an incentive to save for your future, and certainly a very good and commendable incentive that was proposed by the Honorable Minister of Finance. As investors and as individuals, we should be seeking to take more control of our financial future today, and planning and putting away our hard-earned savings and generating wealth for tomorrow. Now, electrification may not seem as a specific initiative or measure for investors, but it does have some knock-on effects to already publicly listed firms such as Massey and Ansel McCall, who are in the automotive dealership business, certainly fairly important segments of their overall conglomerate type businesses. And that proposed measure was the removal of customs duties, motor vehicle taxes, and VAT on the importation of fully electric vehicles. Now, that's the specific publicly listed beneficiaries who could stand to benefit: Massey and Ansel McCall, among the other automotive dealers who are private, of course. There could be another benefit in terms of fuel import reduction, which could make foreign exchange perhaps a little bit less in lower demand by other traditional sources. And as a long shot, perhaps it may become more accessible to the investment community. And of course, it could accelerate private investment in terms of the associated infrastructure for this budding area or budding new industry or sub-industry of the automotive industry. And that could promulgate perhaps listings on the SME or additional investments by publicly listed companies into the industry as well. So in that regard, we consider it a fairly important development for investors to keep an eye on, beyond just the increased demand that Massey and Ansel McCall, among others, would potentially face with those duties now knocked off, at least for the next 2 years, if approved. Moving on to the broader measures and the final segment of the webinar presentation, Well, the fuel market liberalization would have been announced back in fiscal 2021, and it was met with quite a bit of trepidation, quite a bit of concern for the potential inflationary pressures that it could bring about to the Trinidad and Tobago economy. And that really has not changed. The removal of fixed retail margins from liquid petroleum products, including diesel, super, and premium gasoline, really essentially moves us to a floating price regime for fuels, despite a retail margin ceiling being put in place or proposed to prevent price gouging by dealers. So that will have the effect of increasing transportation costs across the industry, increasing input costs, because all of the goods and services that we consume have to be moved somehow across the economy, and they are moved using, of course, as a significant input cost, the price of fuel. And that would, in our view, lead to a very high likelihood of increased inflationary pressures over the next coming period. Now, no timeline was given as to when this is going to be implemented. However, progress would have been made over the past couple months in terms of getting legislation in place and having some pricing mechanisms being tested. Now, one of the measures that was also announced was a fuel cash card to assist vulnerable groups and lower income households with the increasing cost of fuel. In our view, while this is admirable and would certainly help target the fuel subsidy to those who need it most, this may not be enough to offset the broader inflationary impact that moving to a floating fuel regime would have on the Trinidad and Tobago economy in the near term. So certainly fuel market liberalization, let me get that straight, is going to have, in our view, a very strong likelihood of inflationary pressures and increases in the cost of living over the next, when it is implemented eventually. And when we take a look at what that means in a graphical illustration, right now, this is the cost of premium, super, gasoline, and diesel, super in green and diesel in purple. We currently pay just under $5 per liter for super and $3.40 roughly for diesel in Trinidad and Tobago. When you compare to some of our regional counterparts, as at the beginning of October, Barbados was paying the equivalent of $13 based on their floating regime for super gasoline and $10.50 for diesel. Jamaica, on the other hand, was just around $8.25 and $8 for super and diesel, respectively. When we take a look at the equivalent retail price of US Gulf Coast ultra-low sulfur diesel and US Gulf Coast gasoline, it comes in at around $5.60 for diesel and $5.63 per liter for super gasoline. So anyway you look at it, based on current energy prices, a move to a floating fuel regime would certainly bring about an increased likelihood of inflationary pressures for the Trinidad and Tobago economy in the near term. Power and water rates are also going to be subject to revision, as mentioned by the Honorable Minister of Finance. There are some relief measures. There's the increase from a 25% to 35% in terms of a rebate on bills for residential households that are less than $300 VAT inclusive. And there's also in the works a proposed utility cash card to assist the vulnerable groups and lower income households as well. But the regularization, that's correct, yes, of utility rates is inevitably going to have an increasing effect on the cost of living, as well as input costs. And we think about everything from food preparation to just general air conditioning costs. And all of those things are going to have, again, an inflationary effect on the Trinidad and Tobago economy in the near term once implemented. Now, again, no specific timelines were given with respect to these adjustments to utility rates. However, it has been, or this is the second consecutive budget statement in which this has been mentioned, and progress is currently being made as to what those revised rates should look like by the RIC at present. And when we take a look at how our electricity rates stack up to our Caribbean comparables, again at the beginning of, well, these are actually March 2021 figures, we would notice that currently Trinidad and Tobago pays about 5 cents US per kilowatt hour, compared to our Caribbean comparables of Bahamas, Barbados, and Jamaica at around that 23 to 25, let's call it 25 cents per kilowatt hour, which is pretty much 5 times what we currently pay. The general manager of TNTech would have mentioned that the subsidy-free cost of electricity in Trinidad and Tobago is estimated to be in the region of about 9 cents US per kilowatt hour, which is almost a doubling of power costs if we move immediately to that estimated subsidy-free rate. When you take a look at water rates, and admittedly this information is fairly dated, 2015, Trinidad and Tobago pays about 27 cents per cubic meter in USD for water, compared to our compatriots in the Caribbean, Barbados, Jamaica, Bahamas, of between $1.30 and $2.40 per cubic meter for water as well. So certainly there could be a considerable adjustment in terms of the cost of water rates for the Trinidad and Tobago economy if we move to subsidy-free type pricing. And finally, in terms of broader taxation measures, of course, the very hotly debated property tax is coming sooner rather than later, as well as the implementation of the Trinidad and Tobago Revenue Authority. Now, the effects of these would also be inflationary, with an increase in living costs, and as well as an increase in input costs. And we see that from the perspective of commercial business owners having to pay for commercial property taxes, which they would not have necessarily paid comparable rates for over the past few years, having to factor that into their cost of production to turn at least some profit in their businesses. So certainly the impact of those taxes coming into effect and that revenue authority coming into effect, in addition to the lower disposable income, point to inflationary pressures as well for the broader Trinidad and Tobago economy. So we've taken a look at the big numbers in terms of the budget. We've discussed what could be or what may not be case of the skies falling in terms of the imminent threat of debt default by the government of Trinidad and Tobago. We've taken a look at some of the specific measures and opportunities on offer for the investor in the coming fiscal year. And we've taken a look at some of the broader measures that could have an impact on investments in the coming fiscal year. So what are some of the key takeaways? And this is the final slide before we conclude. Well, with respect to economic growth, we are cautiously optimistic. And this, of course, is generally heavily linked to energy production and robust pricing. Our outlook for energy is that, or economic growth rather, is that economic growth should be at least moving into positive territory in the upcoming fiscal year after multiple years of negative growth. And that should help investor sentiment to some degree. Energy production will be a big part of that economic growth in terms of, or driver in terms of economic growth. And given the projections and the likelihood of production increases, as well as the current very favorable pricing environment, investors should be a little bit heartened, particularly for investments such as TTMGL, but also generally in terms of the revenues that are going to be generated by the government or the country over the coming fiscal period. Inflationary pressures, we feel, are going to be higher given what we would have just discussed, coming revisions to utility rates, fuel markets moving to a floating type regime, and generally lower disposable income and higher input costs via taxation, additional taxation. That may put a dent into investor sentiment. And I'm happy that most of us would have responded to the poll before this presentation would have started. certainly we didn't want to taint your own perception. Sovereign debt levels, they will continue to climb, and that will worry investors to some degree. However, we view the risk of default in the near term as being fairly low, both in terms of domestic as well as international debt outstanding. And finally, for domestic interest rates, given the fairly weak economic environment, it is more likely that the central bank will remain very accommodative and keep interest rates a bit lower, particularly given that the shorter end of the yield curve has remained pretty much in check over the past couple years. And that is sort of a mixed bag for investors who would like to see more attractive bond yields to be incentivized to invest on the shorter end of the yield curve. But overall, lower interest rates do help to make the recovery of the economy, Trinidad and Tobago economy, a much more accommodative space for would-be borrowers. And with that, we conclude the presentation part of the webinar. I would like to thank you for listening thus far. So I'm going to stop sharing the screen at this particular point in time, and I'm going to open it up to questions. So let me invite our guest moderator, Jade, who is a valued member of our Bourse team, to unmute and perhaps pose some of the questions that you, our audience, would have been asking throughout. And of course, please feel free to use the raise hand feature if you would like to ask your questions directly. Jade?
Okay, good afternoon, Sarodh. Good afternoon, everyone. So we had a lot of good questions coming in from the audience. Thank you all very much for your participation. So we start you off with a nice, easy one, a softball to get you started. You know, is devaluation imminent?
Is devaluation imminent? That's not. Thanks for that very easy question, Jade, and from our esteemed audience. I think devaluation has been something that has been discussed for the past several years. And we have seen as a country to manage through even the worst of times with COVID-19 without making that adjustment. Devaluation would certainly be quite unpopular for the general population. And in that regard, it's probably going to be a last measure. The initiatives that are being taken right now in terms of trying to reduce subsidies, cut expenditure, and increase taxation are probably going to be further up the menu for the time being. Devaluation may only become an option if things continue to deteriorate at a very rapid pace in a short space of time. Thanks, Jane.
All right, well, now that you're all warmed up, let's pivot away from the general questions and let's go to, okay, why should investors invest in the FCFGH offering when it is being offered on the higher end?
Okay, that's an excellent question as well. Well, in terms of where the stock was, you would certainly be investing on the higher end. So certainly for investors looking at a short-term type return, the $50.60 estimated price may not be particularly attractive. However, the restructuring of first the FCFGH wasn't just done to meet, in our view, particular regulatory requirements. It's probably being done to facilitate perhaps an acquisition drive, like some of its domestic counterparts would have undertaken, Republic Financial Holdings, for example, or just to organize itself for increased efficiencies to become more profitable ultimately. So if you're banking on the future, I would say that would probably be one of the reasons I would acquire first shares in the additional public offering. If you're looking for a quick return, it's probably not going to be the most compelling investment opportunity out there. And just to bear in mind, First would have recently entered into an agreement for the acquisition of Scotia's Guyana operations, as is public information. And of course, for reasons unknown to myself, it's been highly publicized that they would have taken a stake in the Jamaican broker-dealer giant or financial services, well, emerging giant that is, Barita, over the past few years. So those are just some indicators that First is using its excellent capital adequacy position and taking a look with a more regional lens at making some shrewd acquisitions, perhaps, and growing through that acquisition mode, given that the Trinidad and Tobago economy isn't the hottest at the moment. Thanks, Jade.
Thank you, Sarodh, for that fully encompassed answer. You knocked off about 3 questions in that one answer.
Okay.
So let's go on to the next one. Is there a minimum proportion of shareholding which must be offered to the public for an SME listing?
There is, I can't recall it off the top of my head. I believe it's about 25% of the company that has to be offered to the public. But we can confirm that certainly, and with the stock exchange, and get back to that particular individual whose name I'm hoping we have.
Yes, we do have the name, so we can get back to them.
Great.
So next, is the central bond market a good investment for your ordinary low-risk investor? And how would one access those bonds?
A really good question. So the central government bonds, they have been issuances, but they have really been by way of private placements to a large extent, which is banks, different banks winning different mandates to issue these bonds and raise capital. And given the need to raise this capital quickly, it's really being offered to institutions, mutual funds, insurance companies, pension funds, etc., who are natural aggregators of significant stores of wealth over time. At an individual level, we would certainly hope that there would be more access. Unfortunately, at this particular time, for the everyday investor, it's just not the case. But certainly, members of the investment community have been lobbying to have that access widened. But as of right now, the best way to participate would be via perhaps a mutual fund, or if you are deemed a high enough net worth investor, accessing it directly through one of these commercial banks. Jade? I see the messages are blowing up, so that's a good thing, and the questions as well. There's one attendee that has their hand raised, and I'm not seeing the hand. There are now 2 attendees that have had their hands raised. So let me see if we can find them.
Seems Jade got disconnected, but we do have some more questions.
Okay.
We have a few asking about the rate of inflation.
Okay. But what specifically about the rate of inflation?
They would like to know how the rate of inflation outlook is.
Well, I think the general sense in terms of the rate of inflation is upward. What we can assume is that in addition to the current supply chain issues that the global economy is having, which has led to increases in the cost of freight from $3,000 US for a container to $20,000 US for a container from China, for example. as well as the looming effects or anticipated effects rather of the move to higher utility rates, the floating fuel prices, etc. Certainly the direction for prices would seem to be upward, and the removal of those subsidies and the knock-on effect in terms of the cost of goods and services would have to be borne by the ultimate consumer, you and I. So inflation, if I had to put my head on a block, I would say is probably going to tick upward. I can't give an exact number because it all depends on the pricing practices of the commercial community, but certainly it would be higher than it currently is. Right. I'm trying to access persons to allow them to allow us to see who has their hand raised. So let me see if I can do that. Shauna, in the meantime, do we have any other questions?
Yes, we have a few questions coming in. There's a question asking if the outlook for GDP at 5% is realistic.
Okay, that's a good question. And I see Marsha Connell has her hand up, and we're going to get to you right after this question, I promise. So we have traditionally undershot our growth estimates. Okay, and Marsha has a hand down now. Okay, but we have traditionally undershot our growth estimates over the past couple fiscal years. So perhaps 5% in the eyes of persons who have been closely following the economy may be viewed as somewhat optimistic. But within the context of coming off a low base, we think that we may not get necessarily to 5%, but we are cautiously optimistic that we will be in that low single-digit type growth phase, and certainly we'll be hoping to register a positive year of GDP growth after several years of negative growth for the Trinidad and Tobago economy.
We have a question on our repo agreements. They would like to know the minimum amount.
Okay, so it's geared, the minimums are 250K TT or 100K US.
Okay, I have another participant. They would like to know how to build a bond portfolio taking in account of inflation.
Okay, so that's a good question. If you expect rapid inflation, you probably want to be reducing your allocation to bonds and increasing your allocation towards securities that may be more inflation protected. And traditionally, those types of securities have been stocks who have, and those companies that have the ability to pass through increasing cost of production to consumers. So that's something that you'd want to consider in a environment where inflation is expected to pick up. You would traditionally want to underweight, again, as mentioned, that part of your portfolio that you're investing in bonds. And certainly, you would not want to be investing very long-term in bonds. So perhaps looking at a repurchase agreement as an income mutual fund, which gives you some measure of income, is probably a better allocation of your portfolio as opposed to buying, let's say, if you could, 10 or 20-year bond, because the impact of inflation and adjusting interest rates could do some damage to your portfolio's valuation in an inflationary environment.
Okay, good. There's a very interesting question. The HSF seems to be earning a favorable investment returns despite the frequent withdrawals. Do private investors have access to these types of investments?
Well, I guess the answer is a bit of yes and no. The HSF is managed by several very well-run investment firms internationally, and the local component but there's not really any local component. But yeah, it's really managed in large part by the international fund managers. So to the extent that you have access to those international fund managers, the answer is yes. In reality, the everyday investor may not have access to those types of investors. But if you do have access to foreign exchange, something as simple as perhaps buying an index exchange traded fund. So you buy the S&P 500, for example, or you buy, you buy a European ETF, for example. Those things would help you replicate similar, if not identical, performance to that of perhaps the HSF. Having said that, the HSF is a diversified portfolio between bonds and equities as well.
Somebody would like to know what is the best investment in your portfolio in this economic downturn environment?
In my personal portfolio, or just generally?
I would say generally.
Okay, good. Well, right now, energy is on fire. So we anticipate, we are optimistic that TTNGL will benefit from this particular upcycle, given the very robust energy prices that are taking place and the anticipated recovery in gas production and gas volumes in Trinidad and Tobago in fiscal 2022. So that's perhaps one. Massey comes to mind in terms of their cross-listing prospect, and we saw the impact, even if short-lived, of Guardian's cross-listing on the Jamaican Stock Exchange, where the share price, to paraphrase, popped. It has since corrected to its initial listing price, but there was a lot of excitement generated around it. Massey is also a company like Macau and some others on the stock exchange that would have a fair degree of pricing power in its ability to pass through increases in its cost of business, cost of sales, etc., to the ultimate consumer. So those are some of the investments that come to mind, but it's not the easiest environment to be investing in. At the international level, if you do have access to foreign exchange, perhaps looking at index ETFs is always a good way to go. When we think of some of those blue chip companies like the Microsofts, the Apples, etc., those are always pretty good companies to have within your portfolio. And if you want to be a little bit more sophisticated with it, you could actually purchase particular sectors of the S&P 500 very conveniently using exchange traded funds or ETFs as well. So instead of buying a single name like a Microsoft or an Apple or an Amazon, you can buy the entire technology sector very conveniently. So there are, at the international level, there are much more opportunities. It's much more attractive. At the domestic level, there are perhaps a handful of them. Personally, I'm looking forward to the listing details of the Trinidad and Tobago Mortgage Bank, because that's a company, if you looked at it, certainly TTMF has grown from stride to stride over the past couple of years and has made good progress in terms of generating value for its shareholders. And as it becomes public, hopefully the investing public can be able to benefit from that as well.
Somebody would like to know if Bourse facilitates these investments that you are speaking about.
Yes, we do. We are a full service investment firm. So if you would like to participate on the local market, on the international market, repurchase investments, we pretty much do it all. And we are the largest independent broker dealer. This is my shameless plug now. And we have been around for 25 plus years. This is our 26th year, and we don't intend to go anywhere. So yes, we do, and we invite you to contact us, and we can get you started today.
We have a few participants inquiring on the merger of TTMB and
Yes.
how investors would be able to participate on it and the outlook for the economy.
Right. So let's take the TTMB first. I think that, as I mentioned, I think that's going to be the next sort of exciting buzz that is generated in terms of an initial public offering in the Trinidad and Tobago market space. There are no details as yet as to the timing. The Honorable Minister of Finance did say that the merger was expected to be completed within the first half of fiscal 2022, so that's before March of next year. And we are hoping that further to that approval and completion of the merger, that the IPO would take place, between March or April 2022 to September 2022 or thereabouts. And again, our estimates conservatively is that the value of these shares is not going to be a very large IPO by any measure, but the value of the shares, based on our estimates, would be somewhere within $500 to $600 million odd to the investing public. The other part of the question shown is the outlook for the economy.
The person was asking what the merger would mean for our economy, the impact.
Oh, well, it's really just a change of ownership, and it's moving from the private or state hands to the public investment. So in terms of the overall impact on the economy, it's not going to be much. For the investor community, it is an additional option that persons would have when designing and constructing their portfolio. So from that perspective, it is certainly a positive development, but it's not really going to be too much of a movement for the overall economic outlook for Trinidad and Tobago.
Do you believe that the foreign exchange problem will be alleviated soon? And I also have a question asking if hyperinflation will occur in our lifetime.
Okay, so let me take that last question. This hyperinflation is a very slippery slope that we'd have to go down into, and I don't see us. And again, I mean, nothing's impossible, but I don't see the Trinidad and Tobago economy having to deal with a bout of hyperinflation. I feel that as it stands, the central bank is pretty much in control or has a good grip on the economic activity and has their finger on the pulse of what's going on. And it's very unlikely that hyperinflation would be a feature of our economy, certainly not in our lifetimes. But I mean, never say never. With respect to the foreign exchange question, will it be alleviated anytime soon? In my view, I don't particularly think so. We're still at a stage where, given our managed exchange rate, and there is a structural imbalance where there's just simply more demand than supply of foreign exchange, that the central bank has no choice but to intervene and inject foreign exchange on a periodic basis into the commercial banking system. So that process of rationing and prioritization is probably not going to go away anytime soon unless we moderate our foreign exchange outflows or we significantly boost our foreign exchange inflows. And given that our foreign exchange inflows have traditionally and will, in all likelihood, still continue to be dominated by energy sector rents and revenues, it's unlikely that current imbalance or perceived imbalance will be adjusted in the near term. So don't get your hopes up, but I mean, again, nothing's impossible, but it's just very unlikely at this point in time. Shauna?
Hello, we have a question on the international stock market. Do you keep track of stock splits, and is there any particulars that are coming out that you're waiting to buy?
Stock splits or IPOs?
Well, we could probably answer either or.
Okay, well, the international market is quite frankly immense. There are thousands, hundreds of thousands of stocks. So it's pretty hard to keep a track of exactly which stocks are doing splits, etc. With respect to IPOs, it's not a strategy that we actively pursue. I mean, we do have a couple of clients that pursue IPO strategies. At this point, it's a little bit more difficult to get in on the IPO, but you could buy the stock as soon as it begins trading on the secondary and hoping for that upward movement. But there are resources, and I mean, if you give us your contact info, we could share those resources with you, where there is an IPO calendar for US exchange listings, and you could probably just look at it from time to time. It's updated very frequently, and determine whether or not you would want to participate in any of those stocks. With respect to, are there any stocks that we are very excited about that's going to IPO in the US? Not at the moment, to be honest. Even earlier this year, some of the bigger names that came up, we felt that there was a sense of euphoria which had taken hold of the market, and the term that's like that international reporting agencies like to throw around unicorn companies, and we felt that there were one too many unicorn companies with valuations that may not have been fully justified coming to the market.
Are there any locally traded stocks on the equity market that pay dividends in US dollars?
Yes. I believe Grace Kennedy does. And Jade, you could correct me if I'm wrong, working with our research team, as well as First Caribbean International. Those two stocks, I believe, pay, certainly First Caribbean International or FCIB. Well, the stock symbol is FCI. They pay dividends in US dollars.
How does one get access to international markets?
Oh, well, there's this very lovely, convenient service called Bourse Trader. And you can sign up with Bourse Trader. The minimum to open your account is 5,000 US. And once you have that, you can get started trading on the US market. It's fairly easy. And as the name suggests, it's provided by Bourse. So the access is quite easy. And even if you don't want to go the route of direct investing yourself, there are an array of mutual funds that you could also utilize, provided by Bourse and others in the local market space, that would give you access to investing in US markets. Shona?
When purchasing index funds, for example, the S&P, can you place a certain amount a month, or do you only purchase one at a time?
That's a great question, and it's really up to you. There's a lot of flexibility in terms of whether you quote unquote average down or average up. If you're a periodic investor, if you just invest a lump sum once every year, really the choice is yours. And certainly doing a periodic investment is not outside of the realm of possibility, and it is something that investors do from time to time. So certainly that's possible.
Do you have an outlook on TTNGL?
Well, as mentioned earlier, NGL is a cyclical stock, as are all energy stocks. And we would have we seem to be coming out of the worst part of that cycle in recent times, where the stock fell as low as that $14 range. The outlook is admittedly brighter at this particular point in time, with oil prices, which influence the prices of propane, butane, and natural gasoline, which is what NGL produces and trades in, positively. The outlook is admittedly brighter. The company's international foray is certainly one which they have expressed a lot of confidence in, and those trading volumes and those trading margins would be up in the current environment as well. The domestic aspect of TTNGL's business has come under scrutiny, particularly with questions being asked about LNG's Train 1. But overall, in terms of the gas processing volume outlook, in terms of the wetness of gas that they're processing, meaning that they're extracting more liquids per unit of gas processed, and with a more positive pricing environment, and with their regional end markets reopening, or well, at different paces, of course, it's certainly a more optimistic outlook for TTNGL. As whether or not they'll get back to $30 in the near term, that's another question. But they're certainly heading in the right direction with you. Okay, so I guess
okay.
So Sean, I think we'll take maybe about 4 or 5 more questions for wrap up.
Okay, sure. So are there any preferred shares offered on TTSE?
Preferred shares. I think there are. There's Guardian Media preferred share, I believe, but they're not very actively traded. But it's not admittedly, it's not a part of the market that most investors, if any, focus on at all. But certainly we could do the research and provide those answers to you in very short order, if we could take a note of the person's contact info.
We have a question on the outlook for the FCGFH, and
Right.
a question if it's geared towards institutions or individuals.
That's a good question. I would imagine, given the volume relative to the historical traded volumes of first, now FCGFH, the amount of shares that are being offered, as I mentioned during the presentation, are just over 8 times the volume that would have traded in first over the past 12 months. So certainly, for a successful additional public offering, there should be some degree of institutional buy-in. Again, given that it's priced almost to perfection, certainly at the higher end of its trading range over the past 12 months or so, institutions tend to have a much longer term outlook on their investing activities, and therefore it might appeal relatively more to institutions with perhaps longer term investment horizon, as opposed to the individual that might be looking to make a quick return on investment by flipping the stock in short order.
Is it possible to access foreign bonds?
Yes, it is possible to access foreign bonds, and yes, Bourse does it. So you can get in contact with us, and we'll be happy to walk you through that process.
How do you invest in SPACs?
Oh, in SPACs. Well, that is an interesting one. Well, SPACs are it's about as straightforward as investing or purchasing any stock that's listed on a US exchange. But you do definitely have to do your homework. Now, it has become a growing investment strategy for some, where they speculate on the SPAC, which is essentially, and SPAC, for those who may not know, is a special purpose acquisition company. So it's effectively a shell company with cash that has been injected by shareholders, and they go around looking to acquire suitable companies that they feel they can add some value to, or it's almost like an off-the-shelf type of IPO vehicle. So a company quickly wants to get to market. A SPAC could buy the shares of that company and make it available to the public. So buying a SPAC is like buying cash, unless there's already a company within the SPAC. And that's where the tricky part comes in, because you could buy a SPAC and be holding on to it for months or years, and it may never acquire a company and just may unwind. Or you could buy it and the next day it acquires something and it takes off like a rocket. So there's no established strategy. The mechanism of buying the SPAC is quite straightforward. You just, once as you know the symbol, you just purchase it on the stock exchange. But the process of being a successful SPAC investor is a different story altogether. So I think we'll take 2 more questions, Shona, and then conclude. If there are 2 more, if there are no more, well, that's fine.
Well, we have a question asking your views on cryptocurrency.
Right. Very speculative. And it's actually not something that Bourse trades in. So if you are going to dabble in crypto, you have to understand that the whole basis of crypto is anonymity. And it's about validating its usage in the future. So be prepared for a rocky ride. It's not just a straight shot into the sky in terms of appreciating values. So do your homework, but I mean, understand that it's an investment that you can wake up one morning and it's down 20%, or wake up one morning and it's up 20%, as is the case of the most popular cryptocurrency, Bitcoin. So just proceed with caution is the only advice that I could give.
There's a last question. What is your view on the impact of the transition to renewables on CapEx for companies?
On what, CapEx?
Yes.
Oh, CapEx. Okay, sure. That's a good question to close off on. Well, it all depends. The transition to renewables in terms of CapEx would really be more heavy or more pronounced for those companies that are energy producers. So on the one hand, they would start naturally reducing their investments in the traditional non-renewable sources or resources, such as oil and gas deposits. And on the other, they would start, if they are intend to be part of the energy producer landscape for the foreseeable future, start transitioning more towards building their infrastructure and capacity on the renewable side. So it's going to be more pronounced for those particular companies. For persons that let's say running a restaurant, or you have an automotive business. Well, maybe not automotive business, but we'll get to that. Let's say you're running a restaurant. Your only concern is that you're getting power, not how the power is produced. So there won't be too much by way of CapEx in your particular case as a restaurant owner, or as a residential owner. But for automotive business, for example, the push to renewables may mean the end of, or a significant reduction in internal combustion engines, and it may mean retooling and retraining your garage attendants and mechanics and technicians to deal with the electrification, as is being incentivized by or proposed to be incentivized by the Honorable Minister of Finance in Trinidad and Tobago. And having a different skill set in that regard, having maybe different machinery and things like that. So the degree of CapEx investment really varies by the nature of the type of business and what they do and where they are in that energy value chain. So Shauna, maybe we'll take one more because that was a fairly heavy question, and we can wrap up there.
Shauna? Hi.
Yeah.
I think we could probably answer the rest of the questions afterwards.
Okay.
If there was any that we missed out.
Okay, great. All right, well, thanks, Shona, thanks, Jade. Let me just say thank you to all of our attendees for taking the time. We have actually spent a lot more time than I thought we would, about an hour and a half. And I hope it has been enlightening for yourselves. I hope that we've provided, that the Bourse team has provided a lot more insight and perspective for you to make more informed investment decisions. And of course, we remain available. If you do need any services or if you do need any type of advisory, feel free to contact us via our social media platforms. Come in, give us a call, email us, of course. Keep in tune with us via the Bourse report and our periodic publications. And I just want to say thank you to our investment team that would have put together this very detailed presentation in a fairly short space of time. And we look forward to seeing you at our next webinar. Stay safe, everyone, vaccinate. And thank you for joining today's webinar. Take care.